Today, we're looking at an analysis report with headline that really grabs you. It asks, BURU to $1.
Right.
And it suggests that its blue laser technology plus a big pivot into defense could equal a 500% upside.
Yeah. And when you're talking about a stock that's, what, around 20 cents right now?
Exactly.
You know you're not dealing with some slow-moving blue chip. This is the definition of a high-risk, high-reward story.
And that's what the source material is really digging into here. We're dissecting this report on a company called BURU, Inc., and it admits the company's been through a lot.
Absolutely. But the core argument is that two huge factors are coming together right now.
Right.
You've got this unique, almost necessary piece of technology, and then you have this pretty radical strategic shift that's designed to, fix the books fast.
A 500% return. I mean, going from 20 cents to $1, that needs some serious fuel.
It really has.
So our mission today is to walk you through the claims, the data, and the charts in this report. We'll look at the tech, the defense shift, and maybe most importantly, the enormous risks that make this so speculative.
It really is a story of physics meeting financial desperation. The IP is incredible, but the clock on their cash is ticking very, very loudly.
Okay, let's unpack this. Let's start with the foundation, the thing that gives this company its value, the blue laser. Why is this such a big deal? What problem are they even solving?
Well, they're solving one of the biggest physical roadblocks in modern manufacturing. It affects pretty much every EV battery, every electric motor, you name it.
And the problem is with shiny metals.
Exactly. Primarily copper and gold.
Right, and you can't build high-performance batteries or motors without copper. It's all about conductivity.
Precisely. But here's the physics problem. Traditional industrial lasers, the ones used for welding, they operate in the infrared spectrum.
Okay.
And infrared light is just terrible at welding copper. Copper is so reflective at that wavelength that most of the energy just bounces off.
It's like trying to use a flashlight to melt something in a mirror.
That's a perfect analogy. The energy has nowhere to go.
So how do manufacturers even deal with that now?
They basically have to just blast it with high-power lasers. It's slow, it's inefficient, and you often get these weak, kind of porous welds.
Which sounds like a major safety issue for, say, an EV battery pack.
It is. The analysis report calls it the industry's single biggest headache. It literally puts a speed limit on how fast and how well you can build batteries.
And this is where BURU's blue laser comes in. Is it really just about changing the color, the wavelength?
Fundamentally, yes. They shifted the wavelength into the blue part of the spectrum, and physics just dictates that copper absorbs blue light 13 times better than it absorbs infrared light.
13 times.
13. The energy actually goes into the material instead of bouncing off it.
That's not a small improvement. That's a whole different ballgame. So what does that mean for a manufacturer on the factory floor?
It means speed. It means precision and quality. You get faster welds because the energy couples instantly. You get cleaner welds because there's less heat damage. And you get stronger connections, which, for an EV motor or battery, is everything.
What's fascinating here is that they seem to own the IP that solves this huge problem right as the world is going electric.
Right. They have a fundamental physics advantage in a market that's exploding. That's what you call a technological moat.
It is, but as we know, a moat doesn't pay the bills on its own.
Not if you can't scale.
Yeah.
And that brings us to the catalyst, the part of the story that's generating all this speculative heat, the pivot.
Right. The report is very clear that the tech is the prize, but the company needed cash, and it needed it yesterday.
This shift, which they announced back in January 2026, it's what takes the company from being what the report called a science project.
I saw that.
And turns it toward being an immediate revenue generator. It was a move they had to make. They couldn't just wait around for big EV orders to finally come through.
And it wasn't just some internal memo. This involved two specific acquisitions.
Two key moves. First, the move to acquire a company called Lyocon. Second, they increased their stake in another one, Orbit SRL.
Okay, here's where it gets really interesting for me. Lyocon and Orbit. These are the keys to this whole defense pivot. What do they bring to the table that makes this analysis so confident?
Well, Lyocon is in specialized industrial automation, and Orbit provides services for these super high reliability systems. Think aerospace and defense applications.
I see.
So when you take their existing businesses, which are already making money, and you combine them with BURU's core tech, you suddenly have a new company that defense contractors are very interested in.
So you're shifting from the, let's say, chaotic world of EV manufacturing,
which is full of delays and supply chain nightmares,
and moving into the much steadier world of government contracts.
That's the strategic genius, according to the report. Defense and aerospace, they have huge, stable budgets and, most importantly, very sticky contracts.
Sticky meaning?
Meaning, once you're in the supply chain, you tend to stay in. Those contracts are long-term. They're hard to break. And that gives BURU the predictable cash flow they desperately need to survive.
So the blue laser can keep developing in the background while these new acquisitions basically pay the bills. It's buying time with stability.
Precisely. If they pull this off, the pivot solves the cash burn problem, which is the single biggest thing holding the stock down.
Okay, let's talk about the stock itself, the technicals. The report calls it a lotto chart, which is where that 500% number comes from.
Right, but to understand the upside, you first have to understand the pain. The stock was just demolished.
It went from over 80 cents down to 12 cents.
A low of 12 cents, yeah. And the reason wasn't that the tech failed. The reason was a financial catastrophe, severe dilution.
Can you just break down what severe dilution means for someone who might be newer to this?
Sure. Think of the company as a pie. A year ago, that pie was cut into, say, 20 million slices or shares. But to raise cash, they had to issue tons of new shares. So now that same pie is cut into over 200 million slices. Your piece of the pie just got a whole lot smaller. It crushed the price of each share.
And the report calls that 12-cent low a classic capitulation bottom. What does that mean?
A capitulation bottom is basically the point of maximum pain. It means anyone who is scared or frustrated or just had to sell. They've already sold.
The selling is exhausted.
Exactly. The report sees it as the market just cleaning out all the weak hands.
But now it's suggesting a reversal is coming. What are the technical signs that support that?
We point to two main things. First, the chart has formed what's called a rounding bottom pattern off that 12-cent low. It's a slow, gentle curve upward, which suggests people are buying, not panic selling.
And the second sign is volume, right?
Yes. A big surge in trading volume that pushed the price up to 20 cents. High volume on a stock that's been beaten down is often seen as accumulation. The report suggests it's smart money or algorithms betting on the turnaround before it shows up in the earnings.
So if that bet pays off, if these new acquisitions actually deliver real revenue in the next earnings report, that's the trigger.
That's the trigger for the whole thing. There's a big technical gap on the chart from the sell-off, way up at the 50-cent and $1 levels. If the catalyst hit, the report expects a huge wave of buying that could fill that gap very, very quickly. That's your 500% opportunity.
It's a great story. Amazing tech meets a smart pivot, timed with a technical bottom. But now we have to pump the brakes. We have to talk about the risks, because with that kind of dilution and cash burn, can we really trust a $1 target?
And that's the absolute right question to ask. The report itself calls this a high-risk, high-reward speculative play. It says this should only be on a watch list, and only with money you're fully prepared to lose.
Let's get specific on the two biggest dangers. First, that dilution. The share count went from 20 million to over 200 million.
And that number is like an anchor chain to the sock. The risk is huge. If these acquisitions don't bring in cash fast enough, BURU will have to raise money again.
Which means even more dilution.
And that could completely kill any chance of a recovery to $1, no matter how good the laser is.
Which brings us to risk number 2, the cash burn rate. How bad is it?
They are burning through more than $8 million every single quarter.
Wow.
So this pivot isn't just a nice idea for the long term. It's about survival right now. They have to plug that $8 million hole, and fast.
So if the integration of these new companies is slow, or if the revenue isn't what they hoped for,
then they're right back where they started, asking for money, and the stock gets hit again. The report is clear, the strategy is smart, but the execution has to be immediate and pretty much flawless. It's a race between that integration and the balance sheet.
So what does this all mean? We've got this one-of-a-kind technology, a really smart pivot into a stable industry, but it's all weighed down by this history of dilution and a very urgent need for cash.
And the report's conclusion is that at 20 cents, the stock is trading at what it calls option contract prices. It means for a speculative high-risk hold, the potential reward is there. But that reward depends completely on these acquisitions working. Immediately.
It's a total bet on execution.
It is. The blue laser gives them this incredible head start based on pure physics. It's a moat.
I don't know.
And that's the final thought for you to really chew on. This pivot to defense is about stabilizing the company today. But true tech advantages, they don't last forever. Someone somewhere is trying to engineer a workaround.
Right.
So how absolutely critical is it that BURU uses this stability they're buying, to lock in deep, long-term, sticky contracts with major defense and industrial partners? They need to do it before that technological moat starts to get a little smaller. That urgency.
Yeah.
That's the real story here.